Hello students, this is Satnam sir and you are watching my YouTube channel Economics by Satnam sir. In this video tutorials we shall be discussing about understand the concept of investment, can distinguish between the depreciation and the capital loss, need to study the concept of depreciation to distinguish between the gross and net, understand the concept of net indirect taxes and its relevance to reach from factor cost aggregates to market price aggregate. And last, understand the concept of domestic territory and normal residents. But before we start this video tutorials, I shall recommend to all of you to subscribe my YouTube channel Economics by Satnam Sir for very more upcoming video tutorials. So let's get started today's lecture. In this today's lecture, we will discussing about the first concept of national income and aggregates. There are 8 aggregates of national income, out of which 4 are domestic concept and the other 4 are national concepts. We will first discuss the domestic concept, domestic aggregates. The 4 main measures are GDP, gross domestic product at market price. What is the meaning of gross? Gross in GDP MP signifies that no provision has been made for depreciation. That is, it includes depreciation. And term domestic in GDP signifies that it includes goods and services purchased by all units located within domestic territory, irrespective of fact whether produced by residents or non-residents. And the term market price in GDP signifies that it includes amount of indirect taxes paid and excludes amount of subsidies received. That is, it shows that net indirect taxes have been included. And the term product in GDP MP signifies that only final goods and services have to be included. And the next aggregate is NDP MP. What is the meaning of NDP MP? Net domestic product at market price. It refers to net market value of all final goods and services produced the domestic territory of a country during a period of 1 year. Means NDP MP equal to GDP MP minus depreciation. And third domestic aggregates is NDP FC. NDP net domestic product at factor cost. It refers to net money value of all the final goods and services produced within domestic territory of a country during a period of 1 year. And fourth aggregate is GDP FC. GDP FC, gross domestic product at factor cost. It refers to gross money value of all final goods and services produced with the domestic territory of a country during a accounting year. This is a 4 domestic aggregates, and another 4 national aggregate is GDP at MP. GDP at MP means GNP at MP means it refers to gross market value of all final goods and services produced by normal residents of a country during a accounting year. And what is the meaning of NNP at MP? NNP at MP means it refers to net market value of all final goods and services produced by the normal residents of a country during a period of 1 year. And next aggregate is NNP FC. NNP FC means it refers to net money value of all final goods and services produced by the normal residents of a country during a accounting year. And the last component is GNP FC. GNP FC means it refers to gross money value of all final goods and services produced by normal residents of a country during a accounting year. Here students, 4 are domestic income aggregates, and 4 are national income aggregates. What is the basic difference between the national income and domestic income? Domestic income is basically a territorial concept, as it includes the value of final goods and services produced within domestic territory of a country. But national income, it is a national concept, as it includes the value of final goods and services produced in the entire world. Actually, in domestic income, it considers all producers within the domestic territory of a country. But in national income, it considers all producers who are normal residents of a country. Means domestic income, it includes net factor it does not include net factor income from abroad, and national income, it includes domestic income from abroad. So this is a four domestic aggregates and four national aggregate. What is the concept of investment in economics? What is the concept of investment in economics? Investment, students, refers to the addition to the net addition to the capital stock of an economy. Capital, it's also known as capital formation. Capital formation is a term used to describe the net capital accumulation during a accounting period of a particular country. The term refers to addition of capital goods such as equipment, tool, transportation assets, and electricity. Countries need capital goods to replace the older ones that we use to produce goods and services. If a country cannot replace capital goods as they reach the end of their useful life, production declines. Generally, higher the capital formation of a country, the faster of an economy can grow its aggregate income. And the term next topic is meaning of depreciation. What is the meaning of depreciation in economics? Depreciation refers to the fall in the value of fixed assets due to normal wear and tear, passes of time, or expected obsolescence. Expected obsolescence means change in technology. This concept is of depreciation is very important to differentiate between the gross value and the net value. Depreciation, we understand depreciation about the with the help of an example. Depreciation, for example, if a machine is purchased for rupees 10 lakh and its expected lifetime of use is 10 year, then the annual provision for fund is rupees 1 lakh. 1 lakh means 10 lakh divided by 10 year. Depreciation is also called consumption of fixed capital. It refers to that value of fixed capital which is consumed, used up in the process of production. Because of depreciation, fixed assets need to be replaced for time to time. Replacement of fixed capital requires actually fund. There are three reasons for the depreciation. Three reasons for the depreciation. First, normal wear and tear. Actually, continuous use of fixed capital in the production process decreases their productive capacity and value. And after passes of time, value of fixed assets also declines with the passes of time, even if they are not being put to use in the business. Natural factors like rain, wind, weathers, etc. contribute to fall in their value. And third is expected obsolescence. Value of fixed assets also decline due to expected obsolescence, loss in the value of due to technology, or change in the demand of goods and services. For example, electric engine substitutes diesel engine, and due to demand of goods and services, demand for nylon cloths declines with the introduction of Terrylands blends. So the next concept is very important. Students are also confused between the concept of depreciation and capital loss. Capital loss actually fall in the value of fixed assets due to unexpected obsolescence. For example, natural calamity, war and fire, etc. The basic difference is depreciation and capital loss is that Depreciation fall in the value of fixed assets due to normal wear and tear, passes of time and expected obsolescence. And capital loss, it refers to the fall in the value of fixed assets due to unforeseen obsolescence, natural calamities, thefts, accidents, etc. In the case of depreciation, provisions are made for the replacement of asset as it is an expected loss. But in case of loss, no such provision is made in case of capital loss as it is an unexpected loss. In the case of depreciation, it does not hamper the production process, but in the case of capital loss, it hamper the production capacity, production process and production capacity. What is the significance of concept of depreciation in the economy? Depreciation actually, the concept of depreciation is very important to differentiate between the gross value and the net value. Gross net value, gross includes of depreciation, whereas net exclude it. For example, gross value equal to net value plus depreciation. In case of these examples, GDP MP minus depreciation equal to NDP MP. Gross minus depreciation equal to net. And second, NDP MP plus depreciation equal to GDP MP. When we add net value plus depreciation, we got gross value GDP MP. And in the third example, NDP FC plus depreciation. Net NDP FC means net domestic product at factor cost. Net plus depreciation equal to gross. So NDP FC plus depreciation equal to GDP FC. And the fourth example, GDP FC minus depreciation equal to NDP FC. So G means gross minus depreciation equal to net value. Our next topic is factor cost and market price. Factor cost and market price. What is the meaning of factor cost in economics? Factor cost means it refers to amount paid to factors of production for the contribution in the production process. For example, if the cost of producing a set of speaker is rupees 500 and the government levied GST of 10%, then the price of the speaker will be increased to 550 due to the indirect taxes. In this example, 500 is the factor cost and 550 is the market price. So factor cost refers to all factor payment made by the production unit to the factors of production involving the production of goods and services. But in case of market price, it refers to the price at which of the commodity is sold and purchased in the market. The basic conversion difference between the both the concept factor cost and market price is the difference of the net indirect taxes. So before studying the net indirect taxes, we study about the concept of indirect taxes. Indirect taxes refers to those taxes which are imposed by the government on production and sale of goods and services. For example, GST. Indirect taxes increases the price of the commodity in the market. For example, in the previous example, if the cost of the producing a set of speaker is rupees 500 and the government leaves GST at 10%, then the price of speaker will be increased by 550 due to indirect taxes. The indirect taxes increases the price of the commodity, and if the prices are very higher, government want to reduce the price of the any commodity, the government granted the subsidies to the producers. What is the meaning of subsidies in this case? Subsidy means economic assistance or financial assistance. Subsidies are the economic assistance given by government to farm and household with the motive of general welfare. In India, LPG cylinder is sold at subsidized rate. They are often granted to promote export or to encourage firm for setting up the industries in the backward areas. Subsidies are opposite to the indirect taxes as they reduce the market price of a commodity. In the example of speaker, if the government grants a subsidy of rupees 10, then the price of speaker will fall to rupees 540 due to subsidies. The result of the subsidies is fall in the market price. Then factor cost plus indirect taxes equals to market price. The result of the taxes is increase the market price, and the result of grant subsidies is to reduce the price of the commodity. Basically, what is the importance of factor cost and market price in the national income? The basic importance is we conversion the some aggregates into factor cost to market price. Here, the concept of indirect taxes. Net indirect taxes is the difference between indirect taxes and subsidies. Net indirect tax is equal to indirect taxes minus subsidy. Significance. When we added indirect taxes and subtract subsidies from the factor cost, we got market prices. Factor cost plus indirect taxes equals to market price. Some of the important conversions are as below. First, GDPFC plus NIT means when we add net indirect taxes in the factor cost, we got market price. So GDP at FC plus NIT equal to GDP MP. And next, NDP MP minus NIT equal to NNP FC. Net domestic product at market price. When we subtract net indirect taxes for market price, we got factor cost. And in the third example, NDP FC plus NIT equal to NDP MP. Net domestic product at factor cost. When we add net indirect taxes in factor cost, we got market price. And the fourth example, GNP MP minus NIT equal to GNP FC. Gross national product at market price minus NIT means market price minus net indirect taxes equals to factor cost. So G remains same, national remains same, PP remains same, but the variable market price change into the factor cost with the help of NIT. What is the basic concepts of national income and domestic income? What is the basic meaning? What is the meaning of domestic income and national income? So we understand first the difference between the domestic income and national income. We are able to understand the basic concept of domestic territory and the normal resident. What is the meaning of domestic territory of a country? Meaning of domestic territory of a country. Domestic territory is a very important concept in national income accounting. In the layman's language, domestic territory means the political frontier of a country. In addition to political frontier of the country, domestic territory also includes ships and aircraft owned and operated by normal residents between two or more countries. For example, planes operated by Air India between Russia and Japan are the part of domestic territory of India. Similarly, plane operated by Singapore Airways between India and Japan are the part of the domestic territory of Singapore. And second includes fishing vessels, oil and natural gas rings, floating platforms operated by the residents of a country in the international water, where they have exclusive right of operation. For example, fishing boats operated by the Indian fishermen in international water of Indian oceans will be considered as a part of domestic territory of India. And third important point is embassies, consulates and military establishment of a country located abroad. For example, Indian embassy in Russia is a part of domestic territory of India. We repeat once again. Indian embassy in Russia is a part of domestic territory of India. And domestic territory does not include the following items. First, embassies, consulates and military establishment of foreign country. For example, Japanese embassy in India is not a part of domestic territory of India. It's a part of domestic territory of Japan. Once again, Japanese embassies in India is a part of domestic territory of Japan, not India. And second, international organization like UNO, WHO are located within the geographical boundary of the country. According to the UNO, United Nations Economic Territory or domestic territory is the geographical territory administered by the government within which person, goods, and capital circulate freely. This is the basic concept of domestic product. So, income generated within these domestic boundaries is included in the country's domestic income. And what is the meaning of normal residence? Normal residence means normal residents of a country refers to the individual or an institution who normally reside in a country and whose center of economic interest also lies in that country. Normal residents both includes institutions and individual also. Here the terms a center of economic interest means two things. The residents lives or it's located within domestic territory, and the residents carries out basic economic activities of earning, spending, and accumulation from that location. Residents of a country. Actually, residents and citizens are two different concepts. Citizenship, it is a basically a legal concept based on the place of birth of a person or some legal provisions allowing a person to become a citizen. It means citizenship is a can arise in two ways. When a person is born in India, he acquired the automatic citizenship of India. And second, a person born outside India applies for citizenship and Indian law allows him to become an Indian citizen. What is the meaning of residentship? Residentship, it is an economic concept based on the economic concept based on the basic economic activities performed by a person. An individual is a normal resident of a country if he ordinarily reside in the country for more than 1 year and his center of economic interest also lies in that country. I will explain this concept with the help of example. A Chinese living in India for more than 1 year is a normal resident of India. We repeat once again. A Chinese living in India for more than 1 year is a normal resident of India. However, he is not a citizen of India as he does not hold citizenship of India. It means a person can be a citizen of one country and at the same time a resident of the another country. So hope you understand about the concept of normal residents. All households in the economy are not the residents of the country. Those household includes residents plus non-residents household. Following are the non-residents households in a domestic territory includes foreign visitors on conference vacation tours, seasonal workers within the domestic territory, diplomats of other countries living within the domestic territory, foreign employees in the international organizations, and foreign consulates, technician, engineers who comes for a project. Non-residents household in a these are not included in the country's residents. And residents households outside the domestic territory includes citizen of a country employed in their own embassy, consulate, and military base. Second, medical patients and students. Third point, citizenship, citizens working in the local official of international organization. Categories of the institution and person are not treated as residents of a country. International organization like a World Bank, World Health Organization, IMF, International Labour Organization, etc., are not treated residents of a country but of international area. And second, employees of international organization are considered residents of a country to which they belong and not in the international area. For example, Employees of international organization are considered as a residents of a country to which they belong and not of the international area. For example, an American working in UNO office located in India will be treated as normal residents of America. However, if the employees are working for more than 1 year in such international institutions, when they become the normal residents of a country in which such institutions are located. It means, in the given example, if the American is working in UNO office in India for more than 1 year, then he will be treated as normal residents of India. And third point is foreign staff of embassies and members of foreign armed forces located in the given country. Categories of institution and person are not included as the residents of a country. In this category, we also include the crew of foreign ships, aircrafts, etc. and foreign visitor or travelers visiting the country for studies, medical treatment, recreations to take part in sports, cultural events, etc. These are non-residents of a country they are visiting for their visiting. And sixth categories is workers from across the border who cross border regularly to work in the given country. They are treated as residents of the country where they live, not the residents of a country where they work. This is an important concept. Please fill in the blanks. What is the value of fixed assets due to normal wear and tear and expected obsolescence is called depreciation. And second, fall in the value of fixed assets due to unexpected obsolescence is called capital loss. And third, dash is the input output produced within the economic or domestic territory of a country is known as domestic product. What is the difference between the indirect taxes and subsidies? NIT. Lower down the price of the commodity. Subsidies lower down the price of the commodity. And next refers to price at which the commodity is sold and purchased in the market. Market price. Taxes which are levied by the government on production and sale of a commodity is called indirect taxes. And eighth refers to all factor payment made by the producing units to the factor of production on in the production of goods and services known as factor cost. Normal resident is defined as a person who normally resides in the country for more than 1 year and their center of economic interest also lies in that country. And question number 10, factor cost plus net indirect taxes equals to market price. Then classify the following as a part of domestic territory or not. Profit earned by foreign bank in India. Yes, it's a part of domestic territory because bank is operating between the domestic territory of India. Salary of Indian employee working in embassy of Japan in India. No, Japanese embassy in India is not a part of domestic territory of India, but it's a part of domestic territory of Japan. Salary of residents of Japan working in Indian embassy in India. Salary of residents of Japan working in Indian embassy in India. Yes, salary of residents of Japan working in Indian embassy in Japan. Indian embassy in Japan is a domestic territory of India. So, income earned by the Japanese residents from this embassy is included in the domestic income of India. Profit earned by residents of India from its company in Singapore? No, Singapore is not a domestic territory of India. Rent received by Indian from its building in London? No, it's not a London is not a domestic territory in India. Profit earned by Indian employee working in the Pakistan embassy in India? Not. Pakistani embassy is not a domestic territory of India. So salary received by Indian employee working in Pakistan embassy in India is not included in domestic income of India. Consultancy fees paid to foreign experts who stay in India, yeah, it's included in the country domestic income. Earning of American Express Bank branch located in Chennai, yes, it's a part of domestic territory of India. So additional information, suppose a new machine is purchased for rupees 20 lakh having useful life for rupees 10 year after which it falls into disrepair and need to be replaced. In this example, what is the value of depreciation? 20 lakh divided by 10 year equal to 2 lakh annual depreciation value. The formula of depreciation equal to cost of the machine upon useful life in a year. Depreciation is also known as allowance for normal wear and tear. Depreciation is the cost of his capital asset. The another name is consumption of his capital, value of capital consumption, current annual replacement cost of his capital assets, annual replacement investment to keep the value of his capital assets constant, annual allowance of normal wear and tear or unforeseen foreseen obsolescence, annual maintenance and repair of cost of existing capital goods, regular wear and tear of capital, part of capital stock used up in the each year production process, cost of the fixed capital goods divided by the number of year to its useful life. Dear students, in the next lecture, we will understand the concept of net factor income from broad. Comprehend the formula domestic aggregates plus NFI equal to national aggregates. Mean the concept of GDPMP, GNPFC, NDPMP, NDPFC and their interrelationships. Can identify the real flow and money flow in the circular flow of income. Can understand the conclusion of the circular flow of income. Can understand as how saving taxes and imports are leakage and investment subsidies and exports are injection. Thank you very much.